Alrighty, folks, I wanted to do two things with the boys from Convoy Home Loans. A, I want to talk about activity post-election. B, I want to talk about 2025 and perhaps a scary prediction that I have. And then finally, we are going to talk about arms. Let's welcome them to the show. Jonathan, how you doing?
I'm all right. How are you?
I'm doing well. And Dustin's taking this call from the car, man. I appreciate you doing this. It means a lot to me and the audience that you guys will make time for this. So thanks, Dustin.
Yeah, absolutely.
So I want to first talk about activity post-election. It's 8 or 9 days since the election. The results are in. I've talked to lots of real estate investors, probably more than 15, maybe upwards of 20 of them. And all of them have talked about things have picked up, more stuff pending, vacant units full. Maybe this last month of pause really was that. And, people are getting going now that the election is AK over and the outcome is known. But you guys are in the mortgage business. I'm curious what's happened the last 8 days or so. Activity up, down, flat? What's going on?
Yeah.
Oh,
I would say that the month and a half leading up to, the election, there were so many conversations that we had that, clients, specifically investors, were sitting on the sidelines to see who was going to be elected, right? That's a big part for a lot of investors, and understandably so, that they're going to use to plug into their spreadsheet, whether it's now or future projections, right? And ultimately, what I've seen in the last 9 days, 9 days now, um, is a little bit of a pullback. Not much, but I think we're at our cap, hopefully, in terms of let's just give a range cap of maybe another quarter point or a half a point max of where we're at. We had a lot of optimism. Treasury's up a bit. Clearly, Treasury's up a lot, I could say. But I think for now, which you'll allude on, like you said, later in this conversation, we'll ride this for a while until, I think, don't quote me on this, but I think once the dust settles in the economy of how the economy actually truly is doing, that's when rates will come back down. But for now, there's too much optimism on how good the economy is, and inflation this morning, and unemployment, job applications coming down. Like, do I think that's real? No, but we'll see in a year and a half.
Yeah, it's going to be really interesting because, again, I think at the moment there clearly was an unlock. There were clearly some people sitting on their hands. I do not know, nor do I expect it to be a long-term trend, but I do think there were some missing transactions from the last 4 to 6 weeks that will happen in the next 4 to 6 weeks. I don't think you could, that's kind of like delayed demand versus a new trend, but I think it will make the numbers look really lumpy, right? You'll have a gap down and then a gap up, but then we'll be back on trend. So we'll talk about that. But I want to talk about 2025. Again, I think 2025 to me, we're going to have higher rates than expected. I think for the year, we might average 7%. I think the lows will be at the end of the year versus the beginning. I think there's a general opinion among Fed presidents that the neutral rate is higher. They used to think it had a 3 handle. Now maybe it has a 4 handle. Why is that important? That means less rate cuts. I think there is a general feeling that tariffs will be unleashed in the first half of 2025 to create fairer trade. And that may have some impact on the stock market and earnings and things of that nature. So I think 2025 is setting up to be, frankly, the last hard year for real estate agents, the last hard year for mortgage brokers. So I would tell everybody, survive to 26 and life gets better, probably meaningfully better in 2026. I don't know if that scares you guys. You're ready for it, but let me know what you think.
I mean, it's interesting you say that because I think this year everyone's mantra was survive till 25, right? It was the rhyming thing.
Yeah,
And as we saw, and we agree with you, I mean, as we saw the market kind of move and everything settle, like we realized very quickly that rates were not going to be like dropping to 4% levels at the end of the year. I mean, there was people calling for that at the beginning, like big names, right?
absolutely.
Big social media influencers were saying rates are going to drop to 4, and that kind of obviously created a little bit of a craze. But like Dustin said, we're going to be writing this for a little bit, right? And I think that obviously the clients that are winning, as always, are the people that are constantly just factoring it as a cost of doing business and just the cost of capital, and then just moving and pushing forward with that, because those are the clients that we see constantly coming back and doing more deals and better deals, is those that are doing that, and they can cost average down if they need to. The difference in rate in terms of payment wise, if you're looking at something under 250, right, in a mathematical sense, not much, right? So it's more of a matter of like, doesn't make sense right now because that's what you're buying it for. It doesn't make sense right now, not in the future, or what
Yeah.
it was before. So our outlook obviously for 2025, I mean 2024 we had an uptick in volume, and I think in 2025 we'll probably see, hopefully, an increase, just for us in particular, an increased level of transactions, like you said, because people are going to start getting used to the whole notion
Yes.
that rates are not going to be dropping to where they thought it would drop.
No, and again, I think the folks that are around in 2025, like Convoy, you're going to do just fine because half your competition, 60% of your competition's gone. But and you're going to survive. You're probably actually going to feel pretty good. But I think 2026, is going to be a great year. You could see a 30% pop in business in 2026. And I say this with historical precedent. From 1978 to 1982, real estate transactions, mortgages crashed. 1983, they popped 30%. So again, next year, 25 will be the fourth year. It will be the cycle bottom if history repeats itself. And then 2026, likely going to feel like an amazing year. Because if you go up 30% with 60% less competition, that's going to feel really good, I would think. Dustin, don't you think?
Yeah, 100%. And it's funny because, survive another year, another hard year, as you put, which would be 2025, at least for John and myself and Convoy, like, we've survived in what I firmly believe 2022, 2023, and 2024. I mean,
Yeah.
maybe not all of 2024. There's some nice pockets of it for sure, but I'm excited for 2025. I want it to be like this for longer than, and this isn't to any like first time home buyer that I want rates to stay high. I want them to stay at a normal level that
Yeah.
we've had so that we can actually somewhat get back the housing market. And ultimately, like 2026, I don't want it to drop that much. I want rates to be a very slow bleed down because
Yeah.
we're doing just fine the way it is right now. And the quicker that rates come down and the more that rates come down is just going to prolong how long it takes for the housing market to come back healthy where we need it to be to sustain for the next 10 years or during, Trump's
Yeah.
presidency.
And to be clear, I don't think 2026 is going to be some earth-shattering move down in rates, at least not like like we've had the last 4 years. I think what happens if we get used to 7% in 2025, we will see market move and demand, pick up at 6.5, where today rates got to go to 6, right? So the longer we stay at 7, that gap between what people remember and where they are, gets a little closer. So I agree with you. I think 2026 starts to slow bleed down, but that marginal demand comes back quicker, not at 7, but at 6.5, and then a little more at 6.25, and a little more at 6. So I think again, I mean, I don't know how else to say it. 2025 is the last hard year. Survive, build a business model. Don't get ahead of yourself. Don't go bankrupt, buying something and dating the rate. But I think 2026 may be a completely different story. But on that end, Jonathan, you've pulled some data on ARMs. Now, to be clear with my audience, so I'm not talking out both sides of my mouth, I would never do one of these. But lots of my followers are more risk averse than I am. Maybe they have business plans that warrant an ARM. So we'd be remiss if we didn't talk about what Jonathan has uncovered in ARMs today. What do you got?
Yeah, so obviously, I mean, this is with the baseline at 30-year fixed. If you're doing like 25-30% down, DSCR is still like, and we're talking about DSCR, but we're talking about still in the high 6, 7, 6, 8, 7% on 30-year fixed, right? So these arms make a lot of sense maybe for bigger loans, right? That really have a big difference in the principal payment. So anything
Yep.
out, I mean, bigger is kind of relative, but like let's say for numbers sake, like at least 400, $500,000, because that principal payment at least is then like 400, 500 versus like 1, 2.
Yep.
But like let's say if it was like a high 6, low 7 type situation on a 30-year fix, I looked yesterday and I was quoting out for another client, and this is in personal name only. It's not necessarily LLC based, but it's still a DSCR, and I think it would be good for new purchases,
Yep.
potentially. If you're putting maybe 25% down, this is what I found yesterday. Essentially, it's on a 3-year arm. Yesterday, we found a 6 1/8
Mm.
at starting. This is without buying it down. And then you can get it down to a 5.75 pretty easily with less than 1.5 points.
Mm.
The 1-year arm, we get shorter, you cringe a little more. But
Yeah.
1-year arm is 5.75 to start, and then you can buy it down to 5.5 with less than a point. And then on a 6-month arm, which is obviously the riskiest aspect, but it's for those clients that you're
Yeah.
buying it to refi out, or you're just betting that the market is going to be lower in 6 months, which everyone has a different outlook, right? You have to go with what your fundamentals tell you. And if we have those clients that starts at 5.5 and goes down to 5.25 with less than a point. So we're talking about a 1.5% spread on a 6-month versus a 30-year. That's a pretty sizable spread.
Yeah. Again, I just got to be authentic with my audience. I wouldn't touch these with a 10-foot pole, but to your point, they could be right for different people. They may have a business plan that is more short term. Again, there are lots of reasons arms make sense. I totally get it. My business model is set it and forget it, because I don't want that stress. But again, lots of people out there think arms. And what I appreciate with Convoy is you're willing to bring them to the table. You're willing to have that discussion. Some people it makes sense. Some people it doesn't. And I think that's okay to talk about. Just because I don't like it doesn't mean I'm right. There's lots of people that buy arms, every day. Dustin, what do you think? What's your opinion on arms, when they make sense, maybe when they don't?
Yeah, I'm it's going to be dependent on the market, of course, and then most importantly what your plan is, because for example, the 6-month arm one, right, is the scariest because it's the shortest, right? And I'll let John fill in on like the caps of how high it can go to and what we're underwriting it off of. But let's just say simple math in my head, based on a scenario where you're in LA buying a $1 million single family, okay? And your plan is to buy it without hard money debt because you have the money in your pocket to fix it up yourself, right?
Right.
But you're going to fix and flip and sell it, okay?
Yeah. Yeah. It's a great business plan.
7.25, 30-year versus a 5.25, right? 6-month arm, your payment $1,700-1,800 cheaper times
sure.
that 6 months or 9 months, however long you go. That's $15K extra, roughly, depending on the months, right? That you're going to get extra in profit if you go that route. Now, am I saying get a 6-month arm when you're on a W-2 and you're paying for the payment with your W-2 and your job isn't stable? Absolutely no chance ever, right? But this product is just something else that you need to have in your tool belt if you're an investor, because you got to weigh those options, weigh everything.
No, I couldn't agree more. You guys are amazing. If somebody wanted to reach out to Convoy Home Loans, have a discussion about what's right for them, how do they do that?
Go to convoyhomeloans.com and let us know you came from ORAT, that link.
There you go.
Exactly.
How about that?
But the just to kind of reiterate what Dustin is saying, though, on the dollar amount, I think if your loan amount realistically is less than $200,000, right? Just go with a 30-year fix.
Yeah, I agree.
And just go with that, because your monthly payment difference is really not going to make a difference. And people like misunderstand. They think that rates really play that much of a difference into the payment. But what I would tell clients and what I try to compare with them now, and obviously I lose deals for this because there's always lenders and brokers out there that are like, hey, I'm going to do the deal for this rate, but you're buying it down to whatever. I'm like, hey, it might not make sense, but I have to tell you anyways. If you're buying that, let's say you're at like a 6.75 or 7% even, on $200,000 versus, you know, a 6.5%. You're not looking at that much of a payment difference when in reality you will 100% be tempted to refinance in the next 2-3 years, right? That temptation will be there, and all you're going to do is burn your money from buying it down that first time, right? So if it's not that much of a difference, just take, you know, the rate as is without buying it down all that much. Take a shorter prepay, which is what we've been telling clients, like, hey, you want the flexibility. We've been writing so many 1-year prepay loans these days just because we're telling clients you want the flexibility. Like, I know it doesn't seem like it right now, and I know this other person is saying that you can get a 0.5% lower or 0.6% lower by going 5-year or 6-year or 7. I've seen a 7-year prepay, right?
Oh,
I know that Peter telling you that you can do that, but let me tell you that once the market starts to turn 2026 or 27, whatever it is, you will 100% want to refi. So you have to be ready for that moment.
Just like I wouldn't do an ARM, folks, let me be very clear. I would not do a 7-year prepay. Let's just be very clear about that.
Yeah, but I've seen it. And
No, I
people
know.
they're spinning up the craziest things, right? And I'm losing deals, and Dustin loses deals just because it seems like the allure of the current rate as is right now, and they're marrying the current situation. But when you're playing the investment game, it has to be long term. It has to be like stocks. You buy stocks when it's high, you buy stocks when it's dropping. You know, it's called cost averaging down. You kind of have to think about it the same way in the loan side.
Folks, at the end of the day, Convoy Home Loans comes back because they're willing to lose business because they hold themselves accountable for telling them the right deals. Go to convoyhomeloans.com. Please, please, please click ORAT. If you do that, you speak to one of these two fine gentlemen. Otherwise, you end up in a queue with a bunch of plebes. Nobody wants to be around plebes. Guys, you're amazing. Thanks for being here.
Thank
Thank
you.
you.